Hello, so this video is going to focus on accounting concepts and principles within the working environment. So delving straight in, we're going to look at the first of the concepts, which is accruals and prepayments. And we're going to start with accruals. So accrued expenditure is expenditure that has been incurred in the financial year. However, it will not be paid until after the financial year. The full amount then of this expenditure, of this accrued expenditure, will be expensed to the statement of profit and loss, as well as the full amount being a current liability then in the statement of financial position. So to give an example, my year end is the 31st of March 2017, and O'Donnell's, my supplier, sent me an invoice on the 30th of the 3rd 2017. So they have given me 30 days credit, which I am looking to utilise, so I will not pay them until after the tax year end on the 30th of April 2017. So here we can actually see then how the expenditure is accrued within the financial year, but it won't be paid until after the year end. So the double entry then for this will be to debit the expense on the P&L and then credit current liabilities or the payables on the statement of financial position. So working on the same principle then, accrued revenue is revenue that has been earned, however it hasn't been received. So we usually see this where we give our debtors or our receivables credit upon sale. So we would actually then fully credit the amount to the sales or the revenue in the statement of profit and loss, and we'll also recognise it then as a receivable on the statement of financial position. So this will be seen as a current asset. So to use the same example, the year end for me then will be the 31st of March 2017. I have a customer invoice which I have issued on the 30th of the 3rd 2017 to O'Donoghue's. I'm going to give them 30 days credit, and they're not due then to pay me until the 30th of April 2017. So the correct treatment then for this, for the double entry, would be to debit the receivables as an asset and credit the end of sales in the profit and loss. Okay, so moving on then from this. So we'll go to prepayments. So we've got prepaid expenses. So I'm going to take the example here of electric. Again, my year end is the 31st of March 2016. And within that year, my full electric bill was $2,400. However, I decided to pay £3,000. We have to remember, however, that the expense will only be what was actually incurred and not how much was paid, whether this be an underpayment or an overpayment. Thus, we actually have a £600 overpayment, or what could be seen as a prepayment then for the following year. So the treatment then for the prepaid element of the expense of the £600 would be to debit prepayments as a current asset on the statement of financial position, and then to credit the expense account by $600. So that would be the $3,000, crediting then $600 to bring that to $2,400 on the statement of profit and loss. Prepaid revenue we would usually find in the services sector. So this is maybe where a service has been paid for prior to the benefit of the service being received by the client. So yes, the client has paid us the monies for this service. However, we won't be able to provide it until the following financial year. So therefore we should not recognise it within this current financial year. So we will then have to create a liability. So the double entry then for this would be to debit the income in the statement of profit and loss, or the income statement, as it relates to the following year, and then to credit then the deferred income on the statement of financial position. So this would be just in reference to current liabilities. So we have the liability then to actually produce a service for the client in which they've paid. Moving on then to consistency, which is another accounting concept. So basically the issue of consistency focuses on using the same accounting concepts and methods and applying this year on year. So the example that I've chosen here is depreciation. Once we decide on what the economic life of the asset is, and then we choose the method of depreciation to depreciate over the economic life of the asset, be it on a straight line basis or a reduced balance, we should continue this method year on year until the economic life has been fully utilised. So if we decide to depreciate a laptop for 4 years, perhaps using the reducing balance method, we should apply this then over the 4 years until the end of the economic life of the asset. The only time when this will change is when there's maybe been a revaluation then of the assets of the business. So moving on then, we have the concept of the going concern. And this concept then focuses on the assumption that the accounts then will be prepared on the basis that the entity will continue to provide a service. They seek to meet their objectives for the stakeholders and the shareholders, and that would maybe be to make a profit then, or if they are not a profit-seeking business, they might be a not-for-profit organisation, then they will seek to meet the objectives of providing service then to their users. But the main objective around the going concern and the concept and the basis of preparation of the accounts is that the entity is healthy and there is a future for the entity to keep trading. The adverse then to this would be then to prepare accounts on the breakup basis. But only one method should be adopted. The going concern can be adopted, and then a breakup basis be used in the next year. However, you cannot go back then to a going concern. It just would be incorrect. So going on then to the next of our accounting concepts, which is prudence. Prudence really focuses on treating the transactions with cautiousness and due diligence, and addressing the question of, is it reasonable? Is it reasonable to see this invoice as a current liability, or should it be a non-current liability? Perhaps on a junior level, is the documentation you see in front of you a quote or an actual invoice? So it really focuses on analysing the data that you're given and treating it in the correct and appropriate manner. So, is it reasonable? Is it unreasonable? Or is it really full on crazy as the image projects? So this is just a small snapshot of accounting concepts that I would apply maybe on a daily basis in work. I hope this slideshow has demonstrated my knowledge of accounting concepts, and thank you very much for taking the time to watch and listen. Bye.